Hello everyone, I am Sensei Kevlar. Welcome back to the Dojo. Prior to now, we have been focused entirely on how to create profits by trading the market. The tools that the exchanges give us to trade the market are actually fairly numerable. But what we've been focused on so far is just one: buying and selling the asset itself. There is, of course, other ways that these markets work. And as we go to explore these other ways that these markets work, that these products work, that these offerings from the different vendors work, I invite you to very carefully remember your plan. Remember that the plan will make you profitable. Remember that as we go and we look at other ways in which markets can and do work, and remember that what I'm about to teach you is not part of the plan. It's not part of the plan because it's not meant to actually make you money. It's meant to take it away from you. That's how it's designed. But there are ways around that, and there are better ways of leveraging it. And so we're going to explore alternative products today. But first I need to start with fundamentals. Fundamentals about how products work. You see, when we're talking about a market, we're talking about something that is very basic. We're talking about a bid-ask protocol. On one side, you have buyers. They are trying to bid on the price of something. And so it looks like, they are willing to pay $100 for something, they're willing to pay $90 for something, they're willing to pay $80 for something. 70, 60, all the way on down, okay? On the other side of this, you have sellers. Ask protocol. They are willing to pay 110, 120, 130. And when an order goes up on one side that matches an order on the other side, both of them are filled, and the orders are taken down. We all know how this works. This is basic bid-ask protocol. Okay. Now, what I want to focus on today is I want to focus on the underlying asset that we're working with. Let's say for 1 minute that we're not working with cryptocurrencies. Let's say that we're working with an arbitrary asset. It could be a cryptocurrency, but it could be any asset on any market. The bid-ask protocol works in any market where two people, one person is willing to take up the bid side of the protocol, and one person is willing to take up the ask side of the protocol. This is what creates the market. And if we're talking about any asset, we could be talking about, I don't know, milk. Let's say we're talking about milk here. Let's say we're talking about this guy is a market, and he wants to buy milk to sell to his customers, right? This guy's a farmer, and what he's doing is he's got milk, and he's trying to sell his milk, and he's on this side of the market because he's got milk to sell that he produced. This guy's on this side of the market because he's on a grocery. There we go. That's better. He's a grocery seller and he's trying to sell milk. This guy's a farmer and he produces milk that the grocery seller wants to buy. Now, what happens is that you have a lot of farmers and a lot of grocery stores, and all the grocery stores need milk, and all the farmers need to sell their milk. Once again, you have a situation where a bid-ask protocol is applicable. And so a market is set up for people to bid and ask upon this asset effectively being milk here. Oops. What did I just do? I think I just cloned it. There we go. There we go. So what happens here is that the price of milk can float on the market. And what happens is that we have, once again, the farmer over here, and the farmer wants to do something like he sees right now that the price of milk has, I don't know, gone up. And so he says, oh, you know, people are willing to buy at 100, and, you know, the current bestseller's price is 110, but I actually like 100 for my milk, right? Now, the farmer has some fixed amount of milk that he's willing to sell right now, and the grocery store has some fixed amount of milk that they're willing to buy right now. But both of them actually have a much longer term problem on their hands. The farmer could just make this bid right here in terms of making the market and producing a sell order that would meet this bid order, producing a ask order that would meet this bid order. But they both have a longer term problem. Because the farmer has X amount of milk now, and in a month he's going to have more milk from his cows that keep producing it. And the grocery store is going to have milk right now, is going to need milk right now, and they're going to need milk in a month because it spoils on the shelf. So what both of them want to do is they want to set up a contract between the two. Because the farmer is looking at the price of milk and he's saying, oh, I like the price of milk. What's more is I'm in the season where the price of milk has gone up, and I'm speculating that in 6 months from now, the price of milk is probably going to go down. The farmer sees an opportunity to lock in a better price at this time for the next 6 months on the milk that he will produce over the next 6 months. On the other side, the grocery is seeing exactly the same opportunity, but they're seeing it through a different set of goggles. They're seeing that the price has gone up as high as 120 and 130, and these people are looking to get way too much for their milk. So if they can lock it in for the next 6 months, and they're speculating that the price is going to go up over the long term, they could lock in their $100 price with the farmer for the next 6 months by making a contract with the farmer. So that's what they do, is they make a contract with each other. Rather than doing it with the actual milk themselves, what they do is they make a contract to buy the milk over a period. 6 months from now, they're going to receive this amount of milk, and they can redeem this amount of milk at any point during the 6 months for this price. You can see how this contract sets the price in the future. In the future, this farmer will be able to sell the milk at $100 even if the price of milk goes down. In the future, the grocery will be able to buy the milk at $100 even if the price of milk goes up. Now, because we have agreed to create a contract at $100 that both of us have agreed to, okay, for X amount of milk, however much that is, what the farmer and the seller have agreed to do is they have agreed to a price regardless of how the price changes in the future. Now, as we all know, markets can do one of three things, as we have experienced a lot of. They can go up like this, they can go down like this, or they can go sideways, remaining at $100. If in the case where the market goes sideways, the contract for $100 is the same as having actually done nothing, because the market hasn't changed. If, however, the market does something like go up, then the grocery made a deal. Because now people have to pay $130 to get their milk. If, on the other hand, and the farmer potentially lost $30 worth of sale that he could have made. If, on the other hand, the price goes down, well, the farmer made a good deal. He can now sell for $100 because he is contractually this person is contractually obligated to buy for $100 what people are only paying $70 for. In this way, the farmer made $30 on the sale of every contract of milk that he agreed to sell. And the grocery lost $30 because they're paying $30 more than they needed to pay by agreeing to this contract. So what we can say is that the contract, if the price went up, then the contract is worth $30 more. But if the price goes down, then the contract loses $30 worth of value. On the flip side of that, it's the other way around. If the contract goes up, we've lost $30 worth of sale potential. If the price goes down, we've gained $30 on every sale because the price went down to 70, but we're still selling out at 100. Now, what happens is, because we can see that this value of this contract has changed, okay? What's the contract worth in this case? Well, the contract is now worth $70, okay? And what's the contract worth in this case? Well, it's worth $130. Same thing over here, except in reverse. Okay. If the market goes up, his side of the contract has lost $30, but his side of the contract has gained $30. If the market goes down, his side gains $30 and his side loses $30. Now what we can do is remember that we were doing this buying and selling on an open market for milk itself. But then what we did is we derived a contract around that sale. And what we did is, instead of bidding on the asset itself, we bid on the contract for that sale over that price in the future. We'll call this contract a future contract because it sets the price in the future. And we can see that our future contract changes in value based upon the price of the underlying derivative. On one side, when the price goes up, the contract for the bidder, his value goes up, and the value for the seller, for the asker, his value goes down. And on the other side, when the market goes up, the underlying asset goes up. Same thing. He makes $30, he makes $70. What this means is that now his contract is saleable. He can sell his contract. If somebody else were to be speculating that the price of milk will go to $150, they could buy this contract for $130, and then when the price goes up, they could make $20 more on it. Therefore, this contract has a value. Therefore, this contract can be bid upon in a market, in a bid-ask protocol. This contract, this future contract, which is based upon an underlying asset, it derives its value from that underlying asset. So we call that future contract a derivative. A derivative is a contract based upon an asset whose underlying value of the asset drives the contract depending upon which side of the contract you're taking up. Here's why this matters. This creates the opportunity to create a new product. A new product called a future contract. A future contract is a derivative. A derivative gets created, it poofs into existence when a buyer and a seller make a price agreement. And then the value of that contract gets modified based upon the price of the underlying asset. We can see this in action. Let me pull up a chart, and I'm going to go BTC USDT. Sorry, BTC USD. I'm going to go to OKCoin. And OKCoin has their Bitcoin dollar tracker right here. This is their Bitcoin dollar market. 10,600 is the current price on OKCoin. Okay. In addition to this, they also have additional products that are available. If you go to BTC USD, you can go down here and you can see these things down here on OKCoin. They are the forward contracts, the future contracts. And what happens is we're speculating on the price of something in 1 week, in 2 weeks, and in 3 months. And each of these expire at regular intervals. This one expires once a week, this one expires every 2 weeks, and this one expires 4 times a year. Now, what's interesting about this is when you look at these, they don't look that different than the underlying asset. Shouldn't be too much of a surprise. Their price is based upon the underlying asset. But what is different about them is that there is some divergence. What's happening here is that two people are agreeing to speculate on the future price of Bitcoin at the time of this contract expiration. They believe that in the future, this contract will be worth more or less. One side believes it'll be worth more. One side believes it'll be worth less when the price goes up or down, respectively. And in this way, new assets are poofed into existence and new markets are created. Now, these markets do something very interesting. If we take a look at OKCoin and we take a look at their regular market, we can do something called a comparison. What I'm going to do is I'm going to come up here and I'm going to compare OKCoin, BTC USD, except I'm going to compare the actual market to the 3-month market. And then what I'm going to do is I'm going to modify how that looks to be, instead of bars, I'm going to make it a line. Nice thick line, right? Now, what's interesting about this... Hello, where did my regularly scheduled candles go? Ah, that's the other thing I need to do. Sorry about that. While I'm in here, going in here, as soon as I bring this in, I need to make it so that it scales at the same scale as my other price chart. Otherwise, when I go to scale my chart, it won't work. Now, what I'm looking at is I'm looking at the convergence divergence of the price of the future contract against the asset itself. There are times in the past when it has been very much in line. There's also times in the past when it has been very much below. This is telling us something. These times of volatility are telling us that the whales are trying to do something. They're trying to pull the down right here. Look at how far the futures, deviated from the underlying asset. The whales are trying to pull the market down. Look at what's going on today. Here we are back in line with our expectation. Look at this thing, craziness, insanity right there. Okay. Here's what's happening. It's important to understand that because these contracts are simply made up, they're simply poofed into existence when two people agree. What you can do is you can make them based on an arbitrary amount. So instead of basing them upon an actual Bitcoin, they base them upon $1 worth of Bitcoin. And in this way, they can keep the price of the future contract reasonable so you can get in and get a future contract really easy. Because you're just speculating on $1 worth of Bitcoin. But what that means is you can do two things. Number one, that dollar worth of Bitcoin will move within a very, 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 very large percentage because you're dealing with a very small scale, dealing with a $1 scale effectively. And number two, you can do a trick. You can do what's called a multiplier. A multiplier takes what you have and multiplies it by an amount and gives you that much more buying power. The way that it's able to do that is by multiplying the motion in the market. So for instance, these future contracts allow you a 25x leverage. That means if you have 1 Bitcoin, it's like you can buy with 25 Bitcoin worth of power. Now, why would you want to do something like that? Because what happens is you're now moving with the market like you had bought 25 Bitcoin worth. Okay? But what that means is if that market goes down 25%, well, normally you would have just lost 25% of the Bitcoin that you had traded. If that market goes down 25%, you've effectively lost all of your Bitcoin. What it's done is it's amplified your losses. As much as it's amplified your gains, it's amplified your losses. You lost, okay, it's not just 25%, right? The minute that okay, let's say that you bought 25 Bitcoin worth using a Bitcoin worth of leverage. Let's say that you bought right here, thinking that it's going to go up still. Normally this wouldn't be a problem because you could just buy more down here, no problem, right? But if you were to buy your whole portfolio worth of Bitcoin right here, Normally, what would happen is you would come down here and you'd be like, oh, I lost a little bit of money. I lost, a couple $100. If you went from having 25 Bitcoin worth to having 24 Bitcoin worth, that one Bitcoin that you put in would be used to cover the loss, exit your position at a loss, cover the loss, and you would lose everything. You've now lost your entire portfolio. If you had done this the normal way, by just buying the asset, you would have lost, $500 by buying one Bitcoin. Because you leveraged 25x and your position went from 25 Bitcoin to 24 Bitcoin worth, you lost 100% of your portfolio. The one Bitcoin that you put in was used to cover the loss of the one Bitcoin on that 25 Bitcoin position that went to 24 Bitcoin. That one Bitcoin that you had was used to repay that loan, and you lost your entire portfolio. If you want to understand how your position would be different if you were using leverage and trading future contracts, instead of trading the underlying asset like I have taught you to, take your starting position and multiply it by 25. Then try doubling up. See if your portfolio can withstand that. If it can, double up again. Double up again. Remember that you started at 25 times more than you normally could. That's what you're working with. That's what you're working with. That's what you're working with. Take your starting position, multiply by 25. That's what trading with leverage is like. That's what these seemingly innocent future contracts will do to your portfolio. They will eat you up. Okay? So what is the solution? Well, the solution would be, if you want to trade these things, take everything that your plan is doing and divide it by 25 first. Because you're going to be working with 25x leverage. Well, what have you done? Nothing. You've eliminated any advantage of actually working with leverage by reducing the amount that you would be otherwise trading with by 25x, which is 25x the leverage that you would otherwise be getting. You've not done yourself any favors. This is stupid. The reason that this was invented was because markets didn't move 14%, 15% in a 4-hour period. The reason that this was invented was because markets traditionally move less than 1%, 0.71%. That's the percentage that markets traditionally move. And when you're working in a market that doesn't give you 15%, you need something to be able to amplify these tiny motions, to turn the 1.5ers into 15% gainers or losses, as the people do. But when you're working in a market that's giving you 20%, that's giving you 15% a day, you don't need this. You don't need any of this. What you need to be doing is you need to be paying attention to what these guys are doing. Are these guys telling you something? Are these guys telling you that it's time to come down? It's time to come down. Look at where we are. It's time to come down. Look at what happened next. This is a signal. Pay attention to the signal. Don't play this game. Look at what happens. Look at how badly you can lose your portfolio. What if you had just done a normal, what if you had just taken your position and done the same thing without the leverage and multiplied by 25? Multiplied your plan by 25 to start with. Right on down. That's what you would have done. Same thing. For the privilege of working with leverage, for the privilege of doing this, for the privilege of working in a future contract with leverage, for the privilege of working with more money, you must borrow somebody else's money. Now, what the exchanges do is they set up these products to make borrowing easy. You simply place the order and it automatically borrows how much you need. It's that simple. And for that privilege of using that money to do this trade, for that privilege, you pay interest. For however long you hold that position open with that leveraged cash that you borrowed, the leveraged Bitcoin, the leveraged asset, whatever it is that you did, you are paying a premium. You are paying by the 4-minute tick. Every 3.5 minutes, every 3 minutes, every 5 minutes, whatever it is, they are adding on an additional fee to pay the lender interest. So not only have you taken your plan, multiplied it by 25, but you tacked on an hourly, a minutely fee for the privilege of using these products. If you think that using these products is a good idea, remember the plan. Go back to the plan. Take the plan and multiply it by 25 and see if you still think if using these products is a good idea and paying for the privileges. Or if you can simply take your plan and multiply it by 25 and not pay for the privilege. I've not taught you to use stop losses. I've not taught you to use futures. I've not taught you to use leverage. There is a good reason I've not taught you to do that. It's not a good idea. It just isn't. What's a better idea? Well, if you've ever been on something like Poloniex, you might have been over to this exchange and you might have wondered what this margin trading is. Well, this is the same thing. It's leverage. You're just buying and selling, except you're doing it with the privilege of paying for it. But there's a better way. Because as I told you, when you place the order, look at this crap. When you place the order, you lend. You lend. This is a 2% daily loan rate you are agreeing to. Up to 2% daily. Are you prepared to pay 2% daily? 2% daily? I would love to be making 2% daily. Are you prepared to push this button to buy and sell something and hope that you make more than 2% that day? You'd be a fool. No, here's what you do. You come over here and you push this button right here. Here is secured lending. Here is the other side of the margin. Here is the people who are putting up their cash. Here's the people who are saying, okay, I've got Bitcoin. I've got Stellar. I've got, Stellar, and I'm willing to lend it out at a daily rate. And if somebody is willing to do margin trading, they can pay my loan rate to borrow my coins. And if they stop loss out, if they hit too much, the exchange will automatically liquidate, automatically pay you back using their underlying security, using their secured Bitcoin, using their secured Stellar, using their secured Dash, using their secured whatever. Meanwhile, for as long as that position remains open, you're making whatever percentage the market will give you. You see, it's an open ask market. These are offers. When you make an offer, you put your money up to be lent and receive interest on it. It's free money. You got a bunch of Ethereum laying around. Here's an Ethereum market that lends. You got a bunch of Stellar laying around. Here's a Stellar market that pays awesome on good days. It's a little slow at the moment, but it can go as high as 2% daily. Got some Litecoin laying around. Look at what Dash is doing. Got some Doge you're sitting on. You could be making interest on it. Some clams. Some Bitcoin. You could be making interest on your Bitcoin. All you got to do is put it up on Poloniex and lend it. Now here's the problem. Is these markets are dynamic. These markets are based on bidders actually taking the loans by buying and selling here on the margin. Putting up their money and saying, I want to buy, I want to, leverage my position. Because I'm lazy and I didn't figure out to just 25x my plan and do that anyway. I want to pay you being the lender, for that privilege. Well, you take that money. But these markets are dynamic because whatever people are putting up, that's the lowest rate that gets hit first. So when you lend, they snatch up the lowest rate. And then a higher rate remains. And then a higher rate remains. So then in times of high demand, these loan rates go up and up and up and up and up. I've seen them as high as 4% daily. Get locked into a 4% loan for 2 days. These things are giving you 4% it's 8% over the course of 2 days. Made 8% on your money. But these markets are too dynamic, so you need a bot. Fortunately, there is such a thing. There is an automated lending bot, completely free, open source. All it does is get on Poloniex and lend your coins at the highest possible rate. You can configure your own lending strategy. You can withhold a lending percentage of your coins until the going rate reaches a certain maximum threshold to maximize your profits. You can lock in daily high daily rates. You can automatically transfer any funds you deposit from your exchange account into your lending account and start loaning them out. Did I mention diversification? Did I mention pulling coins off the exchange, putting them into wallets? Well, if you're going to sit on a portion of your Bitcoin, you may as well earn interest on it. If you're going to sit on a portion of your Doge, you may as well earn interest on it. If you're going to sit on a portion of your Stellar, you may as well earn interest on it. Dash earns great interest. Look at this interest. You just earn, this is daily. Daily. Find a bank that'll give you, as high as 2% daily when these markets start flying off the hook. It's insane. It just mints money. This damn thing just mints money. This. And it does it for free. And it does it in a completely sustainable fashion. Now, am I saying take all your money out and put it on Poloniex and start lending it out? No. Can Poloniex get hacked and you lose everything? Yeah. Think about it. This is a diversification strategy. This is what you do with some allocation of your portfolio. You make a plan to diversify into the coins that are being lent, and then you lend them. You plan the trade, and then you trade the plan. And that is the way of the trader. Next up, we have Casey. And he's going to show you how to turn this idea into a reality in short order for yourself and get you going into the fast lane of lending. And I'm really excited for it. I hope you all have an incredible weekend, and I look forward to seeing you on Monday, when we'll explore more of how rubber actually hits the road, and we make a lot of money in these markets. Thank you very much.